Hi. So in this video, you will be learning about compliance with prevailing wage and apprenticeship requirements, domestic content requirements, and Build America, Buy America requirements. Next slide. So in this video, we will cover first an introduction to the clean energy tax credits, their context in the law, the prevailing wage and apprenticeship requirements that attach, and the different ways which those tax credits can be boosted via the Energy Communities Bonus, the Domestic Content Bonus, and additionally, we will also do a review of Build America, Buy America requirements and how they compare to domestic content requirements. And lastly, we will also share a list of resources with which you can center your decision making at your entity and also get in touch with attorneys and compliance experts that can assist you in walking through these bodies of law. Next slide. So to introduce the tax credits, we will speak briefly about the Inflation Reduction Act and the context in which they came about in their current form. So the main change we saw in the Inflation Reduction Act was this mechanism was introduced, the elective pay or direct pay for clean energy projects. And essentially what it does is that it enables tax exempt and government entities to claim the tax credits, which were formerly really only used by private industry. And it also provided that a reimbursement of the eligible cost for a clean energy property can be claimed generally in the range of 30 to 70%. And those would be received as a cash refund from the IRS by those entities that file correctly and under the regulations and statute meet the requirements. Some of those entities that can claim the tax credits include cities and local governments, public utilities, houses of worship, community-based nonprofits, and I'll especially draw your attention to the public utilities because many of you watching this video will be in the position to be in rural co-ops and other like entities that will be eligible. And so the main pieces of projects that we see being put into service at this by these projects and these entity types are batteries, and so different kinds of energy storage, geothermal, solar, and wind, among others. But these are just some highlights. Additionally, like I mentioned before, the bonus adders are also potentially available to entities that comply with the requirements to boost the amount of cash refund. Now, the context of the Inflation Reduction Act was modified in terms of the tax credits by the One Big Beautiful Bill Act, known as HR 1, also, and it was signed into law on July 4th, 2025, and it essentially narrowed the runway for the timeline in which these tax credits can be claimed. And so they have earlier phase outs, and there are also new restrictive rules in terms of the materials that can be used, such as limitations on products from China, North Korea, Russia, and Iran. And importantly, these mechanism of elective pay remains available to tax-exempt entities. And so we really encourage folks that are eligible to act soon to secure the incentives and not leave money on the table. For this next section, I'll pass it on to my colleague.
And hi, we're going to talk a little bit about the bonus adders to the underlying credits and how they will affect things and how you can meet those requirements. The first bonus adder, and the one that is most commonly used by most entities that are claiming these tax credits through the elective pay process, is the prevailing wage and apprenticeship adder. Next slide. So the requirements for meeting the prevailing wage and apprenticeship, to meet prevailing wage for most clean energy tax credits, uh, these will provide a 5x increase on the credit value. So from a baseline of 6% for the investment tax credit, meeting the prevailing wage requirements, prevailing wage and apprenticeship requirements, would boost that credit up to the usual 30%, which is why we say most entities are meeting these requirements. These also apply to subcontractors and contractors working on the project. So it's not something that can be gotten around by simply hiring somebody else to do the work. You have to know what your contractors and what your subcontractors are paying their employees as well. The most common piece is that the most common way around this is that the prevailing wage does not uh, become a requirement unless a project is 1 megawatt or over. Projects that are under 1 megawatt of generation capacity do not need to meet the prevailing wage or apprenticeship requirements. They also do not apply if projects began construction before the 29th of January 2023. That at this point, that is rarely a situation, and most of the exceptions we see are just dealing with smaller sub 1 megawatt projects. Next slide. So the apprenticeship requirements, in addition to needing to meet the prevailing wage and pay the prevailing wage in the area, as determined on sam.gov, to earn the full value, projects must meet apprenticeship to journey worker ratios set by the Department of Labor. They're also required to have a certain percentage of total labor hours performed by registered apprentices, and there must be, uh, if apprentices are not available, if they are able to show good faith efforts to request apprentices from registered programs with either refusals by the registered programs due to unavailability of apprentices or a lack of response from the programs, those situations then would mean that the apprenticeship requirements could be fulfilled on the basis of having attempted to meet them and having no apprentices available. Uh, those are rare, they have to be very well documented, and we don't normally see that. In most cases, we are seeing entities engaging with apprentices. The apprenticeship requirements do not necessarily require the ITC-PTC to be smaller than 1 megawatt, and the PWA requirements do not apply if beginning construction again is before 1/29/23. Again, that's a very rare situation. Next slide. Prevailing wage and apprenticeship documentation. These are things that can help to prove that these requirements have been met in the event that there's an audit. These are not documents that are sent off with a return, but rather they are maintained and retained in your records to ensure that in the event that there are any challenges down the road, this can be proven. It's the standard tax requirement. Anything that's on a return has to have substantiating records in the business's own records. So here, to establish compliance with the apprenticeship requirements, you'll want to see copies of written requests for apprentices by the taxpayer or by contractors or subcontractors, especially if you weren't able to obtain apprentices. That's where copies of those requests demonstrating that the good faith effort was made will be helpful. Any agreement entered into by the taxpayer with a registered apprenticeship program or by contractors and subcontractors, documents reflecting any registered apprenticeship program sponsored by the taxpayer or by their contractors or subcontractors, documents demonstrating the prevailing wage at the time that everything was at the time the construction was ongoing, documents verifying participation in a registered apprenticeship program by each apprentice. That includes documents reflecting the ratio of apprentices to journey workers on the job, etc., as well as records reflecting the daily ratio of apprentices to journey workers and payroll records for work performed by apprentices. You'll also want to have payroll records for work performed by any party that's covered by the prevailing wage requirements as well, along with records showing what their job description was, job what their job title was, to demonstrate that the payments made to them are in alignment with the applicable prevailing wage rates for that position, because prevailing wages obviously depend on what position the job is performing. Next slide, and we'll talk a little bit about the low-income community bonus. This is a bonus that, next slide, has to be applied for. So this is a rarity. It's something that has to be applied for before the project is completed, and it's run similar to a grant program. So you'd have to make essentially a grant application for the low-income community bonus. There are 4 subcategories. Whether a project is located in a low-income community, whether it's located on Indian land, whether it's in a low-income residential building project, or whether it's a low-income benefit project where the financial benefits primarily flow to low-income and affordable housing. And it's important to note that a project cannot claim multiple categories. It's possible that it may fit under multiple categories, but a project has to choose one of the 4 categories. It's not possible to stack these subcategories under the low-income community bonus in the way that other bonus adders can be stacked. So, for example, you could take a low-income community bonus and a prevailing wage bonus and a domestic content bonus. All 3 of those would stack together, but within the low-income community bonus, you cannot get a Category 1 bonus plus a Category 2 bonus plus a Category 3 bonus. So you have to choose which of the low-income community bonus types your project is going to apply for, if it might fall under one of those or multiple of those 4 umbrellas. This can add either 10 or 20 percentage points to an investment tax credit, and it's only available for properties that are claiming the ITC with under 5 megawatts in maximum output. So for utility scale, big hundreds of megawatts project, this is not an available category. Next slide, and we'll talk a little bit about the energy communities bonus. This is often kind of conflated with the low-income community bonus, but these are separate bonus adders. Next slide. The energy community bonus does not need to be applied for, and it's essentially a bonus for locating generation property within certain specified energy communities. So these energy communities are either brownfield sites, as defined essentially in CERCLA, and that's something, there isn't a map of those, as you have to essentially vet the site against the CERCLA requirements. It's also available to projects that are located in either metropolitan or non-metropolitan statistical areas that meet certain unemployment requirements and are dependent on coal, oil, natural gas, etc. tax revenues. So essentially the idea here is areas that were dependent on things like coal mines or oil wells, etc., that are suffering economic downturns as a result of those industries kind of sunsetting. So the idea here is that if you locate your project in a community that was dependent on fossil fuel industry and is currently suffering severe unemployment, there's a bonus for locating projects in those areas, as well as a bonus for certain census tracts and directly adjoining census tracts where a coal mine has closed after 1999, or in which after 2009, a coal-fired electric generating unit has been retired. So the idea here is kind of to encourage people to locate projects in areas that are negatively affected by this transition away from fossil fuel industries. Next slide. And the metropolitan statistical areas and other eligible census tracts are able to be looked up in this mapping tool that's available through the US Department of Energy, that's still online. And so those sites are available through the mapping tool. You can look that up. The brownfield designation is something that is not necessarily going to be on the mapping tool, and that's going to be more of a site-specific determination again. So these energy communities, there's possible for up to 10% increase in the credit amount, and it's available to any of the credits under Section 45, 48, 45Y, and 48E, which are the investment tax credit and the production tax credit. This is available for both of those. Next slide. We're going to talk a little bit about the domestic content bonus, which is, again, a very important one that must be met for elective pay purposes, and at least anything under elective pay over 1 megawatt, and is often desirable for other projects in any case. So essentially, this is another 10% adder for projects that use components, a sufficient percentage of components that are manufactured or produced in the U.S. Key thresholds: 100% US made steel or iron. That is structural steel and iron only, not all steel and iron. So you don't need to go in and count who made every screw and rivet on everything. It's applies only to steel and iron that is structural in nature. And that's an important thing to remember for the domestic content requirements. There also must be a minimum percentage of US manufactured products and components, and that's going to vary depending on which specific technology type is in play. It applies widely across solar, wind, energy storage, other IRA eligible projects, any of these tax credit eligible projects, and the percentages vary depending on project type. So that's going to be an important thing to look up. Again, for elective pay projects over 1 megawatt that begin construction in 2024 or later, it's essentially mandatory to meet the domestic content requirements. So that's very important if you are looking to claim the credit through elective pay. That said, while it's a requirement for those projects to meet the domestic content requirements, meeting the requirements will still get the bonus. So just because it's required doesn't mean they're out that 10% bonus. It just means they have to qualify for the 10% bonus or they don't even qualify for the base credit. So it's a very important piece for elective pay projects. Next slide. And a little bit about the domestic content. So you need to include domestic content certification statement when filing the returns. This is the only one where there is an additional documentation piece with the return itself. There are other pieces that would happen, documentation that you want to retain for all of these credits, certainly, but this one requires an additional piece in the filing. For the ITC, you attach the certification to the investment credit form 3468 in the first year that you claim the credit. For the production tax credit, which is kind of a recurring credit for 10 years after placing in service, that certification has to be attached every year in which the credit is claimed. So you'd need to make sure that it's attached not just in the first year of a production tax credit, but in every year going forward with that. Certification should confirm that the project meets the domestic content requirements as of the date it was placed in service. And note, if you use the safe harbor tables, make sure that is clearly stated in that attached document as well. Next slide. So there's really two options for proving that the domestic content percentage for manufactured products has been met. There's the traditional manufacturer direct cost method, where you have to look at direct labor costs, direct materials costs, go in and perform a detailed analysis of the total products in your specific installation, what the percentages are for each of those. This can be very difficult as a level of detail because it requires a lot of data from multiple suppliers, including potentially suppliers located overseas. It also requires a very detailed look at what percentage of your project is made up of each type of equipment, which again can be very time consuming and may not be practical to create, which is why there is, next slide, a safe harbor table that has been created. And these safe harbor methods allow the use of Treasury release tables instead of that detailed supplier data. Essentially, the tables show a standard domestic content percentages for common components, And these percentages can be used to calculate the project's domestic content amount. The benefit is easier compliance, a much lower administrative burden, and it's ideal for projects with complex supply chains. Um, but there may be situations in which your specific project might not meet the safe harbor requirements, but if you go into a detailed project-specific analysis, it could meet the requirements. So that can be important if you are doing things that are very unique to your specific installation. And then next slide. This is just an example of the table itself for battery energy storage systems. There are tables for different technology types, so this is not all tables, every table, but this gives an example of what the percentages might look like for each item in the table. So that's an example there, and there are additional tables in that Notice 2025-08, and that's what you'll want to refer to for that. And the next slide, I'm going to pass off to my colleague to talk a little bit about the Build America, Buy America requirements.
Yeah, so we're going to change gears a little bit away from tax credit requirements and bonuses to talk about Build America, Buy America requirements and do a little bit of a comparison to the domestic content bonuses that you just heard about. Next slide. So Build America, Buy America, or BABA, it's a completely separate federal requirement that gets triggered when a project is using either federal grants or loans or other forms of federal financial assistance. So these requirements are not automatically required for projects that are taking that are eligible for the IRA tax credits, but there are going to be a lot of clean energy projects that are going to combine the tax credit with some form of federal funding. So this is going to make BABA compliance really important on those projects that have some of these blended funding stacks. So Build America, Buy America requirements apply specifically to public infrastructure projects, which are defined extremely broadly and are going to cover many of the projects that are eligible for the IRA tax credits. And the law requires that all of the iron, steel, manufactured products, and construction materials that are incorporated into these public infrastructure projects are produced in the United States unless they are explicitly waived by the federal funding agency. So for iron and steel products, this requires manufacturing in the US all the way from the initial melting phase all the way through the application of coatings. For manufactured products, there are two separate requirements to demonstrate that they are produced in the United States. First, they have to be manufactured in the US, and all of them also have to have at least 55% domestic content within that specific product. The requirements for construction materials are going to vary a little bit because there's 8 specifically listed construction materials, and the requirements for being produced in the United States vary depending on exactly which material you were talking about. So one key thing we want to flag is that unlike the tax credit domestic content bonus requirements, BABA is going to apply to all of the manufactured products incorporated into the project, not a percentage of the project products. So BABA applies to all of these products. Next slide. So the way that it works is the Office of Management and Budget has put out guidance in 2 CFR 184 that specifies exactly what produced in the United States is going to mean for manufactured products, for the specific construction materials, for the iron and steel products. And that's where for each of these products, you can look to see what they need to do to qualify. And all of the products that are incorporated into the public infrastructure project have to demonstrate BABA compliance if you are using funds from a federal grant or loan, unless they are explicitly waived by statute, and that's a very small number of things that are explicitly waived, or they're waived by the federal funding agency. A couple of key points that need to be emphasized if BABA attaches to a project, it's that it's going to apply to the entire public infrastructure project, even if the entire project is not federally funded. So $1 of federal funds on the project means that BABA is going to apply to that entire project. Also, these requirements are going to flow down from that federal award into all subawards, to all subrecipients, and all contractors and subcontractors. So the way this is generally implemented is that these BABA requirements are going to be incorporated through all of the requests for proposals, all of the contracts, and all of the subcontracts. In addition, most federal funding agencies require that their recipients demonstrate that they're complying with BABA, and this is generally going to take the form of a manufacturer self-certification letter for all of those iron and steel and manufactured products and construction materials that confirm that that product does meet the BABA requirements. And for any products that don't comply with BABA, you would need to have a waiver that is issued by the federal funding agency. So all products have to either be complied or be waived or not subject to the law. Next slide. So this slide provides a comparison between the domestic content bonus and the BABA requirements, and we'll quickly walk through these. So domestic content is related to the tax credit, whereas BABA is related to the federal grants and loans. The domestic content bonus is mostly voluntary unless you're over 1 megawatt for elective pay, whereas BABA is always mandatory if it applies to a project. Domestic content is enforced by the IRS, whereas BABA is enforced by the federal funding agency. The IRS has issued notices that provide guidance and information about implementing the domestic content bonus, whereas for BABA, this guidance is going to be issued by either the Office of Management and Budget, and often many of the federal funding agencies have also issued their own guidance documents as well. As we previously mentioned, the domestic content requirements are going to vary across the technology type and over time, and it's going to apply to a particular percentage of items that are used in that project. And this is very different than BABA, which is going to apply to all of the products that are used in that project unless they are explicitly waived. And while domestic content only applies to structural iron and steel, BABA is going to apply to all of the iron and steel products that are used in that project, down to every nut, bolt, and screw. The other important distinction is that manufactured products for BABA have to contain, each one of them have to contain 55% domestic content. This doesn't change over time, and this is for every product. This isn't a percentage of products that are used in the project. So when you have these requirements that are overlapping, it's because you have both federal grants or loans and tax credits. And so that's going to mean you're going to need to apply both of these sets of requirements. And so for contractors and entities that are building these projects, you have to assess whether the documentation that you have is going to meet both sets of standards for both the domestic content and the BABA requirement. Next slide. So we're going to walk through a couple of hypothetical examples. All of these grantee names and company names are entirely made up, but we wanted to provide an example of how some of these requirements might look in practice. So we have a hypothetical grantee, Belland in North Georgia, and they want to claim a 48E tax credit for a small distributed battery energy storage system. I'm just going to call these BESS that begins construction in 2027. And they are looking to purchase that BESS from a company called PowerX1. So PowerX1, they manufacture non-lithium BESS in Florida, and they have 100% domestic battery modules and containers, but they do use inverters from Mexico. This company is owned by another company called All 999, which happens to be headquartered in China. So if Belland were to purchase this BESS from PowerX1, would it meet the requirements for domestic content in BABA? So let's start with the domestic content bonus. So because Power X1's entire battery pack module and container are produced in the United States, those are going to add up to be beyond what the relevant percentage is for 2027 for a distributed BESS. So it's going to add up to about 89.3% if you use the safe harbor table that we showed in an earlier slide. And that definitely exceeds the 55% percentage that these projects would be required to meet in 2027. So yes, these would satisfy the domestic content bonus requirements to be eligible to get that bonus for the tax credit. In addition, if this project was using a federal grant as well, it would also meet the BABA requirements. So this BESS is going to meet the BABA requirements for a manufactured product because they are both manufactured in the US and it contains more than 55% domestic content. Next slide. So for our second hypothetical example, we have a town of Rosamond in Western North Carolina, and they got a grant from the Appalachian Regional Council for a 500 kilowatt battery storage project. They expect to begin construction and place it into service this year, and they want to claim a 48E tax credit. So, what does the town need to do to make sure that they meet their requirements? So, first, for the domestic content bonus, because they're beginning construction this year and they're going to claim the 48E tax credit, the manufactured products in that energy storage technology must meet or exceed 50% of the domestic content bonus, the 50% domestic content to satisfy the requirement, and all of their structural iron and steel products have to be domestic so that they would be eligible for the domestic content bonus. For BABA, they have to make sure that all of the iron, steel, construction materials, and manufactured products that are incorporated into that project are produced in the United States unless they happen to get an approved project-specific waiver. Next slide. I'm going to turn it over to my colleague.
And then we're going to talk a little bit about the prohibited foreign entity restrictions on the new 48E and 45Y investment tax credit and production tax credit. So these are restrictions that came in as part of HR 1, as part of that revision to the investment tax credits. And these impose certain requirements on entities that have connections to what are known as covered nations, primarily China, Iran, Russia, and North Korea, through ownership control or the sourcing of materials. We're going to focus on the restrictions that are applicable to the ITC and PTC here, and that primarily results in the rules falling into three categories. What are known as entity level rules, which look to who owns or controls the entity that is claiming a tax credit. So, for example, entities that are owned or controlled by China, Russia, Iran, or North Korea are not eligible to claim the credit, even if they are engaging in activities in the US or installing equipment in the US. If the company that wants to claim the credit is headquartered or organized in those countries, they're not eligible for the credit. There's also payment level rules, and that's more relevant to the entities that we typically work with that deal with whether there have been payments made under contracts for the qualified facility or the energy storage facility or energy storage technology, whether there have been payments made to entities that are owned or controlled by China, Russia, Iran, or North Korea that would result in a contract that gives those entities effective control over a facility. And effective control, what that means is essentially the ability to be the sole source of replacement parts, the sole option for repair, etc. With the theory being that if a company based in one of these covered nations had the ability to withhold warranty service or withhold service or repair and prevent other entities from performing that service or repair. That would result in that other country effectively being able to turn off the system. So that's where that is. If there are agreements that grant those rights, that can render that facility or that energy storage technology ineligible for the credit. There is also what are known as material assistance rules, and these are the ones that are probably the most of a practical difficulty for entities looking to claim these credits, because they deal with the sourcing of materials for the qualified facility or energy storage technology. And essentially, if there are materials that are manufactured by a company that is headquartered in or organized under the laws of a covered nation, it doesn't matter where those materials are physically produced. If the company that owns the manufacturing facility is organized under the laws of China or is headquartered in China, then those materials count against that material assistance ratio, and there's only a certain percentage of those components that can be used in the construction of these facilities. The big difference here from the domestic content rules is domestic content looks at where a piece of equipment was manufactured. The material assistance rules look at who owns and controls the manufacturing facility. So if a Chinese company owned a facility, then the facility was in the US, even though products from that facility were made in the US by US labor. If that facility is ultimately owned by a Chinese company, those parts would be considered foreign parts for purposes of the material assistance rules and would count towards the foreign percentage. So that's an important distinction between the PFE restrictions and the domestic content rules. So at the entity level, entity level and payment rules begin to apply in the first taxable year that begins after July 4th, 2025. The material assistance rules began for any project that started construction on or after January 1st of 2026. Violating any one of the three with respect to a facility means that it's not possible to claim the credit. The IRS has released some guidance providing additional information on the implementation of the material assistance rules, but that guidance is not comprehensive for every possible PFE situation, though it does help significantly with the material assistance rules. And next slide. It's a very complicated looking slide. It's more for reference, so I'm not going to go into great detail on it, but the idea is that you will have this as a way of distinguishing kind of the similarities and differences between the domestic content requirements, the Build America, Buy America requirements, and the prohibited foreign entity requirements, and how those all interact with each other, because they're all similar but all different, and complying with one does not guarantee complying with everything. We also have here on this, in addition to the Venn diagram, we have the material assistance tables that show what percentage is permissible under the allowable requirements. So for example, for domestic content, what the percentages have to be. For example, most projects about 40% domestic content. For 48E, most projects, the newest things, around 55% for projects that are begin construction in 2027 and later. Whereas the material assistance rules, depending on the type of project, may go as high as requiring 75% domestic pieces or non-foreign components. And so this is designed to be a helpful reference for that when you need to quickly determine what percentages are available. And with that, I'm going to hand it back to my colleague to talk a little bit about available resources.
So this video had a lot of different items that go into an analysis for procurement, for planning and development, for constructing and ultimately putting these projects into service to be able to claim the funding that's needed. and to be able to use the funding that is already available to entities that have federal funding. So if we go to the next slide, what you will see here is a list of resources that are available to tax-exempt entities and in a pro bono way. The primary resource that I'd like to bring your attention to is the Elective Pay Sprint Hub. Essentially, here in this one, if there's one thing you take away from this video is that you are not alone in this. There's many entities that have gone through this process and successfully claim the tax credits and successfully complied with Build America, Buy America requirements, with domestic content requirements, with prevailing wage and apprenticeship requirements. And in many cases, entities will need a team of attorneys to do that. And through this resource, the Elective Pay Sprint Hub, you'll be able to access compliance experts, attorneys like the ones you heard in this video, to be able to make sure that your individual circumstances are the ones that meet the requirements under the laws that we described here. And this video was meant as a high-level overview of the different bodies of law that go into that analysis. But in the other resources that you have here in this page, you will be able to see more in-depth description on just how an entity can make that decision for themselves, and also how to go about the process of claiming the tax credits and ensuring that your entity remains in compliance with other applicable requirements, such as Build America, Buy America, and the others that were on this call. Like I said, the primary one would be the Elective Pay Sprint Hub. But in addition, as of the taping of this video, all these resources remain some of the top ones for your entity to be able to make that analysis internally. And they break down the law in digestible formats. Think of like a PDF version that is to the point and more easily understandable, so that you can walk through with your stakeholders and make an informed decision as you go about the planning and the development and the procurement and the build out of these projects. And with that, I believe this concludes this first video on a high-level overview of Build America, Buy America, domestic content, prevailing wage and apprenticeship, and elective pay. Thank you for your attention.